let's jump straight into it. Welcome to today's Explainer, where we are breaking down an absolute overnight macro earthquake and giving you the exact tactical setups you need for the trading day. If you're navigating these financial markets right now, you need to know exactly what just went down overnight and, more importantly, where those crucial technical levels sit today. We have to start with the massive geopolitical tension erupting in the Middle East, which is driving a sudden, aggressive oil shock. Commercial vessels were attacked in the Strait of Hormuz, Washington just revoked Iranian oil licenses, and boom, Brent crude surged as traders desperately priced in fresh supply risks. And while that geopolitical map is being violently redrawn, look at Wall Street. Samsung perfectly illustrates today's brutal market psychology. I mean, they posted spectacular earnings, yet the stock completely tumbled, dragging the Nasdaq down with it. It really just goes to show that in this environment, even record profits can trigger a sell-off. Expectations are truly the toughest competitor in the room right now. Naturally, all of this geopolitical tension is rippling directly into the bond markets. Investors are scrambling for safety, sure, but they are also deeply fretting over this oil-driven inflation. Because of that, we saw the US 10-year yield push right past that critical 4.53% mark. You absolutely need to watch that level like a hawk today. And honestly, this perfectly explains why the US dollar is bouncing back so aggressively right now. Fed Chair Warsh just reaffirmed an unyielding commitment to price stability. He basically warned that he will severely disappoint anyone betting on tolerance for inflation above their strict 2% mandate. The market heard that loud and clear. So, what does this mean tactically? Well, the dollar is officially back in business. We've got a pretty light economic calendar today, mostly just the RBNZ decision and some minor regional data, so that geopolitical haven demand is the real driver here. Tactically, you want to look to buy on dips with tight stops. You've got solid support down at 100.89, and you're looking up at a resistance level around 101.41. Moving over to Europe, that overnight energy spike we just talked about hit the euro incredibly hard. The German 10-year Bund yield climbed all the way to 2.94%, driven by this global bear steepening bias. And on the data front, it's been pretty quiet, but the French trade numbers completely failed to enthuse the markets, basically acting as dead weight on the single currency. Add to that some pretty hawkish rhetoric from the ECB's Nagel yesterday. He flat out stated he remains fully open-minded for the July and September policy outcomes, refusing to rule out more tightening if inflation expectations start drifting higher again. With those volatile energy markets totally dictating the euro's rhythm right now, the tactical play for the EURUSD is a classic sell-on-rise structure. You're going to be playing off that resistance level up at 1.1447 with your downside support mapped out at 1.1388. Over in the UK, the Bank of England just dropped their latest financial stability report. The good news? The UK financial system remains highly resilient and well-capitalized. The catch? They flashed some pretty glaring warning signs regarding elevated asset valuations, the growing risks associated with AI, and, you guessed it, these ongoing geopolitical tensions. Now, keep a very close eye on the incredibly sticky UK 10-year yield. It surged on the oil headlines, and a break above 4.85% is your absolute line in the sand. If that gives way, it opens up a very unpalatable and ominous path straight toward the 5% plus zone. Despite cable giving up some of its recent gains thanks to that oil spike, the underlying GBPUSD structure actually still remains a buy on dips. You have layered support sitting nicely at 1.3326 and 1.3293, with your top side resistance capped right at 1.3393. All right, let's pivot and take a micro view into India. We need to look at how this global macro tension is translating directly into domestic setups, starting with an absolutely massive currency move. Get this. The rupee just notched its biggest single-session gain in 3 weeks, jumping 0.4%. And this was not just a casual drift. This was a violent short squeeze. It was driven by aggressive dollar selling in the non-deliverable forward market, which triggered stops across the board. The one-month NDF points even briefly reversed recent trends, trading below the onshore forward premium. Tactically, despite that massive squeeze, the USDINR remains a buy on dips. But here is your golden rule for today. You absolutely must watch for a hard break of the 94.48 level. If that holds, look to buy near supports at 94.92 and 94.51, targeting resistance up at 95.21 and 95.43. Now, looking at Indian equities, the Nifty finally snapped its 4-day winning streak, closing slightly down. But under the hood, we are seeing a stark sectoral tug of war. A massive 2.4% rally in Nifty IT, driven directly by heavyweights like Infosys, HCL, and Tech Mahindra, single-handedly saved the broader market from a deep correction. It completely offset the severe profit booking we saw in sectors like realty. And the most glaring example of that aggressive profit booking, retail giant Trent. It crashed nearly 12% in a single session. When capital rotates out in this market, let me tell you, it doesn't walk, it absolutely sprints. So, putting it all together, despite the cautious global backdrop, higher crude prices, and this crazy internal rotation, the Nifty's tactical playbook is still a buy on dips. You're looking to lean right against that 24,344 support with your ultimate safety net down at the 21-week moving average of 24,060. Resistance sits above at 24,561. Before we wrap up this explainer, I want to take a quick, highly relevant philosophical detour to the Egypt versus Argentina football match. Many felt Egypt was totally robbed by one of the tournament's most baffling VAR decisions that erased a brilliant goal. Naturally, the internet was undefeated, dropping the joke. Not even the British Museum has taken as much from Egypt as FIFA just did. But why does that matter for your trading today? Because Egypt showed us pure resilience. They matched the defending champions blow for blow, shrugged off a terribly unfair call, and just went right back out and scored another goal. Whether it's an unfair referee call on the pitch or a sudden geopolitical shock wiping out your perfect technical trade, survival in this game is entirely about dusting yourself off and getting right back in. The reality is, the market's justice system is entirely optional. There is no referee you can appeal to when an overnight headline blows up your position. So keep your stops tight, trust your technical levels, and remember that greatness in these markets is all about resilience. So how will you trade the noise today? Thanks for joining me on this explainer. Stay sharp out there, and I will catch you on the next one.